Hans Goetti, Chief Investment Officer at Finaport Investment Intelligence, and he joins us from Singapore this morning. Finaport overseeing about $1.4 billion in assets. Hans, good to see you once again on this Tuesday. You know, we haven't spoken since Europe came to this rescue deal package, but it looks like there's already a lack of confidence. What are your thoughts?
Well, we had the initial euphoria in the markets, of course, where the markets went up based on hope that something real substantial will come out. But now markets are taking a second look, and they see a lot of gaps. They see a lot of questions that need to be answered. How the recapitalization of the banks will work, the leveraging up of the bailout fund, how the impact will be on the credit default swaps market after a 50% write-down in Greek debt is not declared a credit event, and so on and so forth. A lot of things that need to be answered.
A lot of things that need to be answered. So you hear this consensus from investors saying this is a short-term fix. Longer term, they still have some questions, some doubts, as you highlighted. So how long do you think this rally is going to last? Is it over already?
Well, it could well be over already. I mean, we are selling into this rally, even if it extends a little bit. I mean, the last 5% we leave to others if that's necessary. But the fact is that the markets will trade on fundamentals eventually, and for us, the fundamentals point into the direction of a recession in the United States and in Europe. And in recessionary times, obviously, you do have earnings downgrades. We think that earnings estimates, which are consensus right now, are bound to come down, and we think the market has some downside risk going into 2012.
Now, Hans, you say that you've been talking about earnings and earnings expectations being too high, but you take a look at the earnings season so far in the U.S., 75% of companies have beaten estimates or have come in line. So what exactly are you seeing that might prompt another recession in the U.S.?
Well, the earnings are decent, I would say. This earnings season was not too bad. The guidance, however, has been mixed. I mean, that's nothing to write home about, but this is backward-looking. Now, forward-looking, we think that earnings growth rates will come down, although corporations will do still relatively well. But the indicators we're looking at is consumer confidence, for instance. We think the consumer is in a deleveraging cycle, and being 70% of the economy, if you have to deleverage, it's not gonna contribute much. In fact, it's going to detract value. And of course, at the beginning of 2012, you have some fiscal stimulus measures that were introduced to expire. So that will be headwinds for the economy going into next year.
Okay, so what's your advice? Stay defensive, still in these high dividend yielding plays in gold, et cetera, et cetera?
Well, yeah, first of all, I think there are opportunities in the bond market. I think treasuries still have some way to go, because we think that it's more of a deflationary rather than an inflationary environment for now. Then the high-yield bond space offers tremendous value, because high-yield bonds are discounting a recession already. Equities, on the other hand, we think are not discounting a recession yet. We think earnings, as I said, earnings estimates will come down, so we are underweight equities. But of course, precious metals will also benefit, because there's increased talk of QE3 in the United States. There will be some form of money printing in Europe. Japan has started already. So currency debasement will remain a major theme for the next probably several years.
All right. Okay, one more question for you, Hans. Before we talk next time, what are the things you're closely monitoring in the next 2 weeks? You got a G20 summit, we got non-farm payrolls, and then closer today we have RBA interest rates, and then don't forget PMI coming from China.
Well, that's right. RBA, I think the consensus calls for a rate cut there of 25 basis points. The other indicators, I think, I'm not giving much on these summits and emergency meetings and what have you. You know, this is something the market can look forward to, but the effect of those are relatively limited. We have seen what happens if you have 14 summits in 21 months in Europe and not much has come out, so I'm not holding my breath as far as Cannes is concerned. I think the non-farm payroll number is one to watch this week. That's a relatively a good indicator as to the state of the economy, and we're expecting we're probably in line with the consensus, expecting probably an increase of about 95,000.
Okay, Hans, thanks for your time this morning. Good to see you. Hans Goetti of Finaport Investment joining us from Singapore.